everyone, to Top of Mind with Consilio Wealth. Team Polo is back today to talk about the market sell-off this week. For those of you watching us on YouTube, you will see that we are both wearing polo shirts today. If you're listening via podcast while you're driving to work today, well, you'll just have to imagine both of us wearing polos. Okay, market sell-off. What happened? We're going to talk about the VIX. We're going to talk about safe havens, what went up, what went down. We're going to talk about mortgage rates. We're going to talk about the carry trade. Anybody know what that is? It's kind of an interesting conundrum. That is thought to have unwound in the last couple of days. And then finally, retail investors sell, institutional investors bought. Okay, next topic, the Fed pause. The Fed is highly anticipated to lower interest rates later this year, but did not in their most recent meeting. Maybe I just blew the punchline there, but we'll talk about that a little bit more. And finally, the Sahm Rule. Has nothing to do with wine, although I'd love it to be to change our...
I didn't know Sahm was a wine.
Well, you can become
I'm not a connoisseur.
Yes.
Oh, got it.
A sommelier.
I was thinking Zin, Sahm, and Merlot. Okay. Sahm is short for sommelier. Okay.
Sahm is short for sommelier. Yes. I'll teach you about wine. You teach me about finance. Let's have a podcast.
All right.
Yes, wine and bonds. We were just down in Napa a couple weeks ago. It was hot. We normally go later in the year. I love it down there. I think it's beautiful. For those that don't know, I'm a little bit of a wine geek. By geek, I mean I'm the guy during the tour that keeps asking questions. How do you make that? What do you do? Oh, you gravity feed. Oh, tell me more. Oh, can I see that? Oh, what's that barrel for?
Yeah, I'm the guy who's like, stop asking questions so I can drink already. Come on.
Probably everybody else is saying that, but I'm having a great time. And so, they're like, oh, budget 90 minutes for a tasting, and I'm there for like 2.5 hours. I just like to geek out about it. So how did we get here? Okay, Claudia Sahm, who is not a sommelier, by the way.
That we know of.
Nor am I. Created a rule, and that rule signaled, holy moly, we're going into recession. So we thought we'd unpack that. Whew. Okay. Let's see here. Market sell-off. God, there's a lot to talk about here.
Yeah.
I guess.
Are you worried?
Me? I'm not worried, but I'm in the business of not worrying, right? We diversify. We keep clients invested.
Next topic.
Yep, next topic. Okay. Okay. So Fed pause. People pay us to not worry about this stuff, Let us worry so they don't have to, right? I mean, it
doesn't mean we don't know what's going on and haven't looked under the hood, though, for sure.
It's normal course of markets and business. I mean, look, if you look at it, I think the market is just back to like where it was last month. Okay, whatever. Like, I think it's just so helpful to zoom out sometimes and go. I remember telling people during COVID, it was like, you have the opportunity to buy the market. I forget what it was now, but you have the opportunity to buy stocks at prices that you haven't seen for 4 years or something like that. Like, all craziness aside, that's a good deal. Let's do it. And, we sent out, our firm sends out what we call for cash emails. Those of you listening that are clients, I'm sure have received one of these before. So when markets draw down a certain amount, we send out a call for cash, which is kind of we have no idea where the bottom is or if this was bottom, but things have pulled back, and, we think you should throw some money in. And we think that if you wait long enough and look backwards in time, you're going to think that was a great decision in doing so. And we get a good number of people that email us back and say, oh yeah, I've got cash sitting here. I've been meaning to email you. Thanks for the nudge. No amount is too small. Kick it in. And then we go back and we review that for everybody based on the date that they said yes. We had one person during the COVID drawdown that nailed the bottom. Oh, that's so great. That's so great.
What was that, March 23rd, 2020? Yeah.
That sounds right. I don't know. But it was just, we sent out the email and they replied back on the right day, and we pulled in the money. And it was a good chunk of money too. And then that was the bottom. It's gone up ever since. So anyway, should we talk about the VIX? Let me let you dive in. Market volatility and market sell-off. You go.
Yeah, it looks like we're recording this on Friday, 10:25 a.m. Pacific. So the market has rebounded, at least clawed back some of the losses that we've experienced really to start August. The Sahm Rule, or this, again, name any rule that some talking head will pull up and it will say, oh, this rule is triggered. There's always some kind of rule that some talking head's going to point to when we have a sell-off. It's just a convenient way to assign a narrative to something that's happening. We'll get into what we think really happened. And again, even that explanation is dubious. But
next week we'll be talking about the How rule.
Yeah, because I'm going to make up some really arbitrary rule if the half moon is out and it's the 9th of August and the market is up 2%. That means, a Democrat's going to win. There's so many unrelated
That's the
things.
How rule.
Yeah. And we see pundits get on financial news, talk like this with a lot of credibility, but alarm bells are ringing in terms of explaining this sell-off, how little sleep we lost over this. So let's get into it. The VIX, I think it helps to understand that the VIX was abnormally calm the past 18 months, right? This goes back to October 2022.
Can you explain what the VIX is?
Yeah, the VIX is the fear index. So this is a traded index that the futures market trades into. So they just look at quite a few things in terms of what's the market thinking then over the next 30 days, right? So do bond rates go up, right? Or when we refer to bond rates in this conversation, it's always the U.S. Treasury because there's little to no default risk. So we're talking about the risk-free bond, or bonds that have as little risk as possible. So we're just talking interest rates. So the VIX does measure, it's called the fear index. It does measure what's baking in, right? What's the market going to potentially be nervous about? And I wrote an article that's titled How We See Risks. If you go to ConsilioWealth.com and go to blogs, I should know this. It's in there. But type in How We See Risks. And it was talking about how calm the VIX was. And the VIX, there's no fear when the market goes 1% up a day, right? Because it's steady. Nothing's really shaking traders or investors. So I was just saying it was just really odd how tight the return streams are, where in 2024 we have a chart from Charter. They take data from FactSet and they compared how unnatural the lead up to this point was. 2024 saw very few days, one day actually, with a 2% move or more. And that was in February 22nd. That was actually a 2% up move. The rest of the time, it was within a really tight range of negative 2% to, let's call it 2%. Mm-hmm. That's abnormal, that tight band, right? 2020, for example, very volatile year. We had a day in the negative 10 range, negative 8 range, negative 6 range in a single day for the S&P 500. On the flip side, on 2020, this is volatility as well. A +9, +9, +6, +4, +4, right? You remember how choppy 2020 was? Like,
oh yeah,
some mind-boggling up days though too. Everyone forgets, focuses on the negative or the down days, but the up days were mind-boggling as well.
Well, nobody calls volatility when the market goes up.
Yeah,
it's not volatile. It's good news. It's like,
yeah. So in a regular year, we do expect at least five days where the market swings up or down 2%. 2024 had one of those, and we were all the way through July before we experienced any 2% moves, specifically to the downside.
Mm-hmm,
yeah, mm-hmm. That's incredibly abnormal. 2023 was much of the same bunching. 2023 was a great year, as everyone remembers. Zero volatility. 22, more volatility. The amount of down days, we got a handful of negative 4% down days. And just to remind everyone, it was the inflation scare year, right? So volatility is normal. I think that the biggest thing we want to point out was the beginning of August was not abnormal. That was actually more normal than the 18 months leading up to that point, right? When markets are calm, complacency prices in or starts settling in, and the only way to really shake complacency is to slap people around a little bit. And people woke up for sure.
Yeah, this woke everybody up and woke up the media, and I feel like my inbox has been full, and this always bugs me so much. My inbox has been full with all of these investment companies reaching out, like our diagnosis, and like, this is why we think this is not a time to panic and stuff. It's like, oh God, just cool it. Like why are we highlighting something that's normal, and instead like no one's talking about what you just said, right? I'm actually trying to find it in our previous decks here. But what you just said is that volatility in the last really year has been so much lower than average, and now volatility shows up and everybody's freaking out. It's like, actually, we are now in the normal category.
Yeah.
Actually, we're still abnormal in terms of how few
even
days.
Worse than that is like we have downside products that you should get your clients into. Or,
of course. Yeah.
Again, annuity companies will definitely come out of the woodwork during this period where, investing in the stock market is bad for you. You should get something lower return but guaranteed return. And that's an unfortunate bug of our industry.
Here it is. I found it. This was on episode 51. So if anybody goes back to that, it was a great episode that we talked about some volatility. We talked about commercial real estate delinquencies. We talked about the trend of inflation, and a couple other good things. And I just want to kind of reiterate this chart that was in this deck that we talked about. So at the time, 2024 year to date, there was only one, and you highlighted it, one plus 2% day so far in the year. Now there's also been a minus 2% day. So we are at 2. The plus and minus greater than 1% was at 20 at the time. So I'm sure we've added a few by now. That is so low. The average, so let me even go backwards here. 2023 calendar year, 64 days that moved greater than 1%, only 2 days that moved greater than 2%. So, okay, great. We're equal to 2023 now, whole calendar year, but we are still so far below even those above 1% moves at 64 versus 20 year to date, halfway through the year. 2022, everybody remembers that year. We had 122 days that were greater than 1% in either direction, 46 days greater than 2% in either direction, 12 days greater than 3%, 3 days greater than 4%, and 1 day greater than 5%. So the point of all this is I tie it together. The average, 62 days plus or minus 1%, we are at about 20. 17 days plus or minus 2%, we are at 2. 7 days plus or minus 3%, we are at 0. 3 days plus or minus 4, 0. 2 days plus or minus 5, 0. So that's where we're at.
This is a really calm year, even with this little pullback. So what the pullback was for the S&P, it was down 9% from peak to trough, and in a normal year, 10% is the median. The worst year was down 47% in 2007, 2008. Right, and then 2020, the worst it got was down 34%. As a reminder, and again, this is when the commentators and talking heads come out of the woodwork. This is like Black Monday in 1987, the savings and loan crisis. The market was down 33%. Mm-hmm. What the news forgets, though, past Black Monday in 1987, November and December, those 2 months alone, up 30-something%, mm-hmm. and the index or the S&P ended the year positive. Mm-hmm. So that's that's the bigger story than the sell-off. Sell-offs will happen. It just the sharp rebounds are probably the story and where the money is really made.
Your next chart here, God, this is the issue with our industry that just drives me crazy. All the emails that we've gotten, exactly your point, right? This protects against downside. This does this. This does that.
Yeah.
What you're about to talk about here is what are forward-looking returns after a 5 or 10% decline. And we know the answer to that, right? It's so obvious. Markets generally go up and to the right.
They rebound, yeah.
And there's, of course, some marketing, financial data about this, but like you just don't. This doesn't show up in your inbox. So like we hope to bring this to your inbox, listener, because this is the real data. But
yeah.
Oh my God. Okay, carry on. Let's talk
Well,
about
if you
this.
had the guts to buy Monday, you bought low and you're pretty happy this week. So again, there's that. The next chart this is all data from Goldman. The next chart is S&P performance following the last 39 pullbacks going back to 1980. And the pullback is considered a 5% pullback. So some years you just might not get that opportunity. And I know this runs counter to what we've been saying too, is the markets tend to go higher after setting new highs. But with an upward bias in the market where, 70% of the time the market's up, odds are when you're buying low, you're going to be okay. Odds are when you're buying high, you're going to be okay. So you should probably always be buying. That's what we're saying. But this chart does look at the 5% pullbacks. The median return over the next month is 3%. That's pretty good snapback. Next 3 months, the average return or median return is 5.5. 6 months after, the median return is 7, and 1 year after, the median return is 11 to 12%. This is starting from the day after a 5% pullback.
That's great news.
Yeah, you're buying low. I don't think we need to overthink that, right? But buying low comes with scares, and we'll go into what spooked the market.
By the way, a pullback, is that a technical definition? Is a 5% decline a pullback, or is that something that
their term is correction
term is?
a correction is a 10%
right?
pullback. The Nasdaq did hit correction territory at negative 13%,
Yeah.
but that's more of a high flyer index than the S&P 500 is.
I think the important thing here to highlight is the math. Like why down markets are so powerful is going down 10%.
Yeah.
Let me say it differently. Going up 10% is, I'm going to get my thoughts here right. Something can, in theory, go up an unlimited amount, but something cannot go down an unlimited amount, right? It can only go down 100%. And so that's where this compounding really starts to work, right? So if you have the opportunity to buy something 10% lower than it was before, or 20% lower than it was before, that could be 1/5 of all the value that disappeared. And if you generally think that over time things recover and grow, that's a phenomenal entrance point. But you don't get the same metric on the way up, right?
Yeah.
You don't know if I bought 10% up, am I going to get another 10 or 20 or 30? But you have pretty reasonable belief, or you should, at least based on the data, as long as you're well diversified and yada yada, that if something goes down 5 or 10 or 20% at the index level, you're very likely to have a good entrance point on that.
Yeah, so that's a 5% threshold that we went over. The next one is the 10% correction territory. So over the next month, again, it's pretty mixed. The average is down negative 2%. The median is up 2%. So in the 5% pullback variety, we saw consistently positive returns over the next month, 3 months, 6 months, and 12. And in a correction, right, it just shows you really can't time the bottom perfectly, which is probably doesn't even matter for long-term investors, right? So over the next 3 months, the median return is 5%. Over the next 6 months, so time is now playing into this.
Hold on, this is talking about with a recession, with no recession.
Oh, sorry.
Yeah.
They changed the chart up on me using the same colors. Sorry.
Didn't change the colors though.
So with the recession, then sorry, let me take that back. With the recession over the next month, the average is negative 2%. With no recession, which is kind of a normal year, The average snapback is 2% in a month. The next category is 3 months, even with a recession, right? 3 months after a 10% pullback, you're flat. And that's very little time, right? That's with a recession. Without one, you're up 5% on average. 6 months, and then this is where time kind of comes back into play, right? With a recession, you're up 4%. Without a recession, you're up 9%. And then 12 months is a little iffy, but maybe because everyone coins the term double dip recession, so you have this false bounce and then back down again. So over the 12 months, oddly, with the recession scenario, after a 10% pullback, the average return is about 1% over 12 months.
Which I would stare at that chart and go, hooray, you got to buy for a whole 12 months at the same price.
Yes.
And then it went up.
Yes.
Of course, that's what I'm going to say. But
without a recession, you're up over 10%.
Yeah, so you recovered. So without a recession, you recovered in a year, on average. With a recession, you had flat returns within a year, with some kind of strange periods where maybe it went down a little bit more, maybe it went up a little bit more, like at that 6 month and that 1 month, kind of those call outs.
Yeah.
But in all of these, and of course we've all seen charts like the longer you hold, you just increase your odds of making money. But with all of these, it would have made sense to buy the dip.
Yeah. And thanks for correcting me on that chart, because so there are two charts side by side with the same color coding. I assumed they're going to,
Bad design. Exhibit 2 and Exhibit 3. Bad design, Goldman. Bad design.
Yeah. So, let's go to the VIX. The VIX spiked up to nearly 50. And when I wrote that article, the VIX was at 12. So we're looking at a nearly 5-fold increase in the fear index, right? That shows, one, is the fear overblown? I would say yes. But the complacency was settling in so much that the VIX was so low that unfortunately it had nowhere to go but up, right? And for reference, the VIX in COVID, like the peak of COVID, was 76, 77. So we got about halfway to COVID, essentially, in terms of fear and panic in in the market, which...
That's wild.
Yeah, the next quote I have here is, according to the VIX, the worst market events in our lives were the 2008 financial crisis, COVID, and the Bank of Japan raising interest rates by a 0.25 percentage point. Because, I think, one, the snapback was because the complacency had been baked in so long. And COVID was just a year removed from the Trump trade tariff drama towards the end of 2018. So there was still a little bit of fear lingering in the market, even though 2019 was a really good year. So that's probably what has to do with the relative spike compared to the other events.
That's crazy. I love this quote.
Yeah.
So should we shift into the carry trade? And I don't want to jump ahead, but that kind of has to do with this Bank of Japan.
Rates, so let's explain what the carry trade is, and if you're having trouble sleeping, I think this will help put you to sleep.
No, don't say stuff like that.
So the carry trade for foreign currencies are kind of out of everyone's purview because they're always focused on their domestic currency, but foreign currency does have a lot of global trade ramifications. So I talked about my vacation to Japan and everything was cheap because the U.S. dollar was so strong, right? And my dollar went further after I exchanged to yen. And when I went there, it was about 140 yen that I was getting for every dollar that I exchanged. So I wasn't the only one who noticed the weakness in the yen, right? There was other traders who borrowed the yen in getting a really low or zero interest rate, and then taking that borrowed yen and exchange it into U.S. dollars and putting it in a U.S. savings account, gaining 5%, right? So you're borrowing in 0% currency, you're converting it to the let's say home currency, US dollar, and investing that currency at 5%.
Mm-hmm.
And that's a risk-free. Some people will take the yen exchange and then convert it to US dollars and invest in the US stock market, right? Because you're getting free leverage. At least that's what the thinking is, right? So when the Bank of Japan raised rates by 0.25%, everyone who was in that trade, which is typically hedge funds, to the tune of billions of dollars, right? If I were doing it, it wouldn't register. But if the Bank of Japan suddenly made borrowing the yen more expensive, right? Because they raised the rates from 0 to 0.25. Then these hedge funds are saying, well, this carry trade might have risk if the Bank of Japan raises rates too fast. I'm going to have to revert that trade. So I'm going to have to buy back those yen that I've been borrowing so I could close out my position in the U.S. Is that making sense?
It does. It makes total sense.
Okay.
My question is, still though, how does that really impact markets? I mean, billions of dollars wiped off the face of the earth when the market fell.
Yeah.
You can't possibly tell me that all that was sitting in this carry trade.
No.
And, so I get it as an explanation, but I just don't get it in terms of like actually like the mechanics.
Yeah. So the mechanics, one, the carry trade is been made bigger by the media than it is. Because if you're borrowing in yen, you're borrowing at a lower exchange rate because you have to convert it back to US dollars. So you're not getting as many dollars to invest as you would have during a normal exchange period, right?
Yep.
So one, you have less dollars to invest, and two, you're exposed to exchange rate risk. So now you have to exchange back if you want to profit off in US dollars. And we're talking small percentages for people who do this right. They're called arbitrageurs, but they're not soaking up 20% returns, right?
Can't be. I mean, I'm looking at this now. A year ago,
Yep.
it was, let's say $1 would get you 144 yen.
Yep.
It spiked to 151. That's a decent move, but not crazy. Then it went down to 141. Okay, so we're not moving a lot. Then it went from 141 all the way to 161. That's a good move. And then July 9th, 2024, it's just been plummeting. So, it bottomed out. Actually, today it's at about 147. So
Correct.
if you look at the 1-year history going from about 144 to 147, it's virtually no change, which is good. That's what you want. You want to borrow the currency at 0% and then invest. Let's say you just put
Correct.
it into a high yield savings account and you made 5%, and then you exchange it back for 0% difference. That's good. But I see your point too, and in fact, the point is a little bit more scary potentially in July when
Exactly. Yeah. So the scary part was Chris pointing out is you got to pay back 140 yen, and if the yen drops against raises against the U.S. dollar, you're having to exchange your U.S. dollar for less yen, and you got to make up the difference.
Right.
So again, I don't think the trade had much market weight. It might have triggered like an initial sell-off at the open on Friday, right? Because there was quite a few things. Jobs report came in lower than expected on Friday, and also this arbitrary Sahm Rule got triggered because of that jobs report, which we'll get into. So it was like this confluence of things all happening at once on Friday, which we know spooked retail investors, because retail investors had a net sell of a negative $1 billion. So they pulled money out of the market for fear of losing their investment.
Mm-hmm.
One, it's kind of doing the exact opposite of what everyone's been told when you start investing day one is buy low, sell high, right? So you're selling after an initial gap down, right? Because the market will open lower, and you won't have a chance to sell a market at 100, and then it trickles down to 99, 98, 97. No, if the market's at 100, it will open at 90, and then your opportunity to sell from that point doesn't even exist, right? Mm-hmm. That's what we call a gap up or a gap down.
Mm-hmm.
And retail investors see red and they run for the hills. And they're thereby confirming their moniker of dumb money, because we just consistently see this time and time again.
I'm sure that some people saw that the custodians went out.
Yeah.
Maybe you saw it in the news. Hopefully you weren't impacted, because hopefully you're not in there day trading. It actually affected us. We were submitting some trades. We trade almost every day in client accounts. We're constantly rebalancing or tax loss harvesting, or clients send money in and we invest it, or we need to send money out for two clients. So we tend to trade almost every day. So we had submitted some trades that were just sitting. And so we were actually impacted too on the institutional side through our custodian. But, of course, there were these memes that came out for all the big custodians, Fidelity, Schwab, Pershing. Actually, I don't know if Pershing went down, but Fidelity and Schwab did. Anyway, and it was like, okay, hold on, everybody. We got to get all the institutional investors in before the retail investors sell, or something like that. It's like,
yeah.
Okay.
But ideally, knowing retail behavior, because they were a net $1 billion seller, which is well below the 12-month average, right? So you would want to keep trading markets open so the retail investors could keep bidding their assets down. Therefore, the institutions can pick up the pieces.
Oh, totally, right? I mean,
Right.
the meme was just making let's let all the institutional investors sell before things really drop, and then let the retail investors go out, right?
Okay.
And that was my point that I did not eloquently make a second ago. But what actually happened is that we know now from the fund flow data that retail investors sold, and institutional investors bought. And
they bought $14 billion. So, institutional, the smart money, actually bought the dip.
See, they're listening to our podcast. It's great. It's great. See, the people should have FOMO around investing, not the FOLI, fear of losing investment. We should not have FOLI. Assuming you're well diversified and you're doing the right things in your portfolio and your asset allocation matches your risk tolerance and you're not 100% invested in a single stock that could blow up, okay. We should all have FOMO, not FOLI, around our investments, I think.
Okay, so new term created, FOLI.
I mean, you call it the Sahm Rule, I call it the FOLI rule.
Yeah.
I mean, I'm just trying to get the word out there.
Yeah, all right. Let's go to since you brought it up, let's go to the Sahm Rule. So this was a rule named after Claudia Sahm or Cynthia Sahm.
Claudia, I believe.
Claudia. She made her rounds, and she refuted her own rule. But let me explain what the rule is. A rise of 0.5% or more in the unemployment rate, which stands at 4.3% within a 1 year time frame, right? So a 0.5% move in 1 year is a pretty rapid movement in the labor market, specifically for unemployment, right? So unemployment counts if you're in the labor pool looking for a job or currently working, right?
Mm-hmm.
So 2024 saw a rise of 0.6 so far over 7 months. So this did jolt on the same day as the Bank of Japan unwind. The jobs report came out and triggered what we dubbed as the Sahm Rule. Claudia herself has made her rounds, and she says, I didn't name the rule, I just identified a pattern, and even though this does fit a pattern, we created jobs. So the jobs number came in positive, but it came in lower than expected. But the weird quirk about it was the unemployment rate actually ticked up a 0.1%. How did that happen, right? We created jobs, but we suddenly had more, in terms of percentage, more unemployment.
Yeah.
That's because we had labor force entry. I know Chris and I talked about it. This is a good sign that people are entering the workforce at higher numbers than jobs are being created at the moment. So what was viewed as a negative is actually a positive, and again, it is immigration. It is people kind of coming of age and coming back to the labor market, right? Let's say you retired during COVID, you did okay, you got bored, you're coming back. Mm-hmm. You're now counted as one labor pool participant. The 18-year-old who decided to forego college and go to work, now part of the labor pool. Immigration, part of the labor pool. So now we have all these new job seekers who just jumped in. They're not going to find a job in a matter of days, right? That takes time. And that's what caused the unemployment rate to jump up, is because all these new job entrants came in. It's pretty simple explanation, but the market reacted negatively, like we're headed towards recession. That's just not true with the data.
Question for you: are these numbers seasonally adjusted? And what I mean by that is, in the summer, so you mentioned young people getting jobs. Summertime, I would imagine there's a job spike with young people because they're not in school, and we know that there's a holiday spike with people, right? Because companies, Amazon does this, right?
Yeah,
they
good
hire
question.
1 million temporary workers for the holiday season. So, are these seasonally adjusted numbers?
The numbers themselves are not, but the expectations of those numbers are.
I see.
That's why if we come in below expectations or above expectations, again, they should hover around those expectations, which are already adjusted for the seasonality of jobs.
Okay, so you're saying unemployment ticking up was really a result of more people looking for jobs, and then they're counted in the unemployment numbers for a short period of time until they're employed, but also the jobs number sucked, right? It was real bad. 114,000?
Added versus an expected.
Like two something? 215 average over the prior 12
Average.
months and 114.
We
was
expected
terrible.
about 150,000. Yeah.
Okay, so it wasn't as bad. So 150 and 114 is what the actual number is. I mean, I guess it's not horrible, but it's not good.
No, it's slowing for sure. But everyone focused on the uptick in unemployment percentage.
Right.
And it's just not quite there in terms of people are losing jobs or staying unemployed for longer periods than they should be.
Yeah.
Yes, that's something to worry about, but we added jobs to the positive, right? So we started contracting jobs.
Right.
That's where I think a more apt use of the Sahm Rule would be applied there.
I mean, also, what's not mentioned in any of this, because this is what kind of a lot of the numbers, or at least the media is pointing to, which is, the cause of the sell-off was everything that we just talked about. But big tech came out with earnings and it wasn't that great. It was a mixed bag. They're being held to such a
high standard
growth, right? You have to grow at 47% in your Microsofts. You have billions and billions of dollars, so many billion-dollar businesses. And it's oh my God, we only grew at 36%. Holy moly, we're slow.
Yeah.
What? And so, there's a big sell-off in big tech that could have sparked this too, sort of the repricing of some of these companies that have been held to such a high standard.
Yeah, I think that's a more fair reason, I guess, because Microsoft invested all this in AI, and investors are rightfully asking, where's the payoff?
Where's the money? Right.
Yeah.
Right. Starting to ask every quarter now.
Yeah, and we're throwing money into a black hole. We don't know if we're going to get profits out of it. And to be sure, Amazon and Microsoft both had really good quarters.
Totally.
Highly investable quarters, just didn't meet higher expectations.
Well,
big difference there, right?
Google came out and said there's a greater risk in under-investing than over-investing, so we're going to spend tons of money. Meta came out and said, heads
Same
up,
thing.
we're going to spend a ton of money next year on CapEx. It's is this going to be like the metaverse
Meta,
days?
yeah.
Who knows, right? But these companies are spending a ton of money on this, and they're sort of starting to warn investors that it could hit their bottom line. I think Wall Street's answer to that is going to be, show us that it doesn't, right? Show us that you're actually able to monetize this stuff. And I think Meta's probably done arguably the best job at that already. Remember when Apple came out with that security update, and they said that the Facebook app couldn't track. You have the ability to turn off tracking.
Yeah.
And there's all these pictures in financial stuff with Tim Cook throwing arrows at Mark Zuckerberg and they hate each other and all this stuff, right? Well, that tanked them, right? Because the whole concept behind Facebook and Instagram is it's
Targeted
an app.
ads, yeah.
Well, yes, but it's an app that lives on another device. They don't control the rails.
Got it.
Whereas Apple controls the device, for example, and so it is a requirement that for them to make money it has to go through an Apple device or a Windows device or whatever. My point is they took that and they said, okay, we need to scrap everything and we need to redo how our advertising algorithms work. And we need to completely figure out how to make this more efficient without actually scraping the data that we used to, because we're not allowed to anymore.
Yeah.
And so I would argue that they were one of the earliest adopters with AI. And now advertisers are saying it's better than it ever was before. So they've invested $1 zillion to it. They've actually had a payoff, and they've achieved a couple of quarters ago that trifecta of revenue growth, bottom line growth, and actually fewer employees. I would argue they've been able to AI and automate their business.
It sounds like you're talking about Abercrombie and Fitch.
Hey, I like that too.
Yeah.
Anyway, my point is I think they've been able to monetize really well. I don't know if they're going to be able to break that out for Wall Street, like, oh, this is the added value. But I don't know of any of these other big companies that are truly monetizing yet.
Let's hope they do.
I think that's going to be 2025, right? Wall Street's going to start saying, like, okay, show me the money.
Yes.
So cool. That was fun. We covered a lot. We actually we got through more than I thought. I thought we were going to kind of land on some of these topics and go super deep.
I'm
we got through it all. All right, awesome. Thanks everyone for tuning in today. As always, the Polo Boys will be back in 2 weeks, and we'll catch you then. Thanks,
all right.
much.
Thank you.